Welcome to The Explainer. For the longest time, the standard playbook for Indian investors has been pretty straightforward. Indian stocks, Indian mutual funds. And hey, there's absolutely nothing wrong with that. But what if I told you that the very companies that power your daily life probably aren't in your portfolio? Today, we're going to break down exactly how and why Indian investors are starting to look at the US stock market.
So, let's just start with this simple question, one that might actually change how you think about your money. Take a look at the phone in your hand, the computer you work on, the apps you use all day, every day. Are you just a consumer of all this amazing global innovation, or are you actually a participant in its growth? I mean, it's pretty clear, right? For so many of us, our lives are just completely woven into these global tech giants. They've changed how we live, how we work, even our culture. So the real question becomes, should we just be customers, or is it time we became owners? Just think about your average day. You probably wake up to an alarm on your iPhone, you search for everything on Google, your work probably runs on Microsoft tools, and the massive AI boom that everyone's talking about, well, that's being powered by companies like Nvidia. These aren't just businesses, they're literally building our future. But are they in your investment portfolio? And that realization right there, that's the core of this whole mindset shift. It's about making a move from being a passive user of all these incredible products to being an active owner in the companies that are shaping our world. Because look, if these companies are growing thanks to all of us here in India, why shouldn't we grow right along with them?
All right, so this all sounds good. But why exactly should an investor in a fast-growing economy like India even look overseas? Let's dive into the two key, really logical reasons why adding US stocks to your portfolio can be a very smart move.
Okay, so the number one reason, and this is super important, isn't about chasing some crazy high returns. The main motivation is getting access to pure innovation. The US market, well, it's a market of ideas. It's where you find the companies that aren't just making profits. They are fundamentally designing what our tomorrow is going to look like.
Now here's where it gets really interesting. This is the second big reason. See, when you invest in India, your return is based on how the market grows. Simple enough, right? But when you invest in the US, you get a potential second layer of returns. You get the market growth from the stocks, plus you could also benefit from the US dollar getting stronger against the rupee.
And look, this isn't just some theory on a slide. If you look at the history, there's been this gradual, consistent trend of the US dollar strengthening against the Indian rupee. Now, over the long term, that currency movement can add a really impactful second dimension to your investment returns.
So let's be super clear about something. This is not some anti-India strategy. Not at all. The goal is not to replace your Indian investments. Those should always be your core. This is about adding a global dimension to make your portfolio more robust and more diversified. Think of it as India and the US.
Okay, let's get to the questions that probably stop most people in their tracks. Is this even legal for an Indian investor to do? And isn't the whole process just ridiculously complicated and expensive? Let's clear all of that up right now. The answer is a big, resounding yes. It is 100% legal. The entire thing is regulated by the RBI itself under a framework called the Liberalised Remittance Scheme, or LRS. This isn't some weird gray area or a loophole. It's a well-defined official channel. Under this LRS scheme, every single Indian resident can send up to $250,000 US abroad every financial year, and you can use it for things like investments. That limit, which is over 2 crore rupees, is way more than enough for pretty much 99% of retail investors out there. And yeah, I get it. This whole process used to be a total nightmare. You had to go to the bank, fill out tons of complicated forms, and pay crazy high fees. But technology has just completely flipped the script. Today, the process is simple, it's seamless, and you can do the whole thing right from your phone with total transparency.
So we've established it's legal, and it's actually pretty simple now. So how do you actually get started? Well, there are two key concepts that have basically blown the doors open and made the US market accessible to everybody. This first one is an absolute game changer. It's called fractional investing. See, a single share of a company like Amazon could cost thousands of dollars. But with fractional shares, you don't have to buy a whole one. You can buy just a tiny slice of that share for as little as $10 or even $5. It makes every single company accessible. And hey, what if you don't want to spend all your time researching individual stocks? Well, that's where ETFs come in. They're basically your best friend. An ETF is like a ready-made basket of stocks. So for example, you can buy an S&P 500 ETF, and with a single click, you instantly own a small piece of the top 500 companies in the US.
It's instant diversification.
And as you can see here, several popular fintech platforms have made this process incredibly easy to do. It is important to know, though, that not all of the major Indian brokers, like Zerodha, for example, currently give you direct access to U.S. stocks.
All right, last lap. Let's tackle the final piece of the puzzle: taxes. I know, the word itself can sound pretty intimidating, but the rules are actually quite straightforward.
So the tax you pay on your profits, your capital gains, it really just depends on how long you hold the investment. If you sell within 2 years, that's considered short-term, and the profit just gets added to your income and taxed at whatever your slab rate is. But if you hold on for more than 2 years, it becomes a long-term gain, and you get taxed at a much more favorable rate of 20% with indexation benefits.
And for any dividends you might get, a 25% tax is taken out in the U.S. But, and this is the key part, thanks to a tax treaty between India and the U.S., you can claim that amount back as a credit when you file your taxes in India, so you don't get taxed twice. It's the same thing with the TCS on large money transfers. It's also reclaimable.
So, when you put this all together, what's the big takeaway? It's that investing in U.S. stocks is not some magic trick or a get-rich-quick scheme. It is a simple, logical step toward building a smarter, globally diversified portfolio for your future.
So, we'll just leave you with this final question to think about. In a world where your daily life, your work, and the technology you use are all completely global, shouldn't your investment portfolio be global too?